it's very easy to give away money. Any fool can do it. Sit in the corner of the street, you have customers. And so because in service of that mission, responsible credit that is productive, the models are very useful because it makes sure that we don't give out too much money. We're looking at, okay, how much can Samora really afford, right? We're looking at if maybe we gave you, 100 shillings, right? Or we offered you 100 shillings. You took only 60. That's a positive in our book because that shows that you're actually responsible.
Nigeria is one of Africa's largest economies. Depending on the stats, it's anywhere between a $350 billion, $400 billion economy. I think if it wasn't for the recent devaluation, it would be by far the largest economy in Africa. On top of that, it's got one of the largest populations. But yet, despite all that, depending on the stats, the number of Nigerians who've taken a loan in the last 12 months, based on whether you're looking at World Bank or IFC stats, is close to 2 to 5%. When you compare this to countries like South Africa and Kenya that range between 25 and 20%, it's very clear that there's a massive credit gap in Nigeria. And who better than to discuss this conversation with Ngozi, who's been in the industry for over 20 years, from a financial perspective, but has been building in the lending space in Nigeria for quite some time. So I'm really excited to have Ngozi on the show. My name is Samora Kariuki, founder of Frontier Fintech. And with me today, I have Ngozi Dozie. I think I've said it properly. Ngozi Dozie, co-founder of Carbon. He's been building in the credit space for the last, over a decade. So welcome, Ngozi.
Thank you. Good to be here. Big fan of your writing. So great to be here. Thank you for the invite.
Thanks, man. And man, I've been really looking forward to this conversation. And, before we get into the business stuff, I think, I was looking at your profile, read quite a bit of the stuff you've also written in your newsletter. And, you've got like a perfect CV, right? So you went to Oxford, you went to Wharton, you worked at all the right organizations. If you're my big bro, my mom would be on my case all the time. Why can't you be like Ngozi? So it's like a fantastic CV. And yet, most people with your kind of background would have taken get a very comfortable job at the World Bank or at a large, firm. You decided to go into Nigeria and build a lending business. And so I just want you to tell us, the thinking behind that, what really inspired that move, and what was going on at the time.
Right. Yeah. Look. Thanks for the kind words. I think it's a nice CV, but it's more a CV of somebody who doesn't know what he's doing. So just trying to get things that will be fine, right? Nobody will blame me for taking an accounting degree or going to Oxford University, like you mentioned.
Yeah.
So I think that's what it was. But then coming to, if you like, why lending, why Carbon? I think so. So for context, I come from a finance family. My father founded a bank, and for certainly in the last, 2005, 2010, really. With my brother, who's my co-founder at TJK, we're looking at Diamond Bank, how they were operating in retail, and we saw a gap. I think for the likes of myself, who have, a good background, all the right degrees, we can actually take a lot of risk, right? And in fact, people like us should take risk because I'll always be able to get a job in a bank or an accounting firm, etc.
Yeah.
So my definition of hell is me actually doing some 9 to 5 or 9 to 8 job. I tried that. I was at JP Morgan for a year and a half, worst time of my life.
Yeah.
Not because of the firm, but because I was so unsuited to it.
Yeah.
And so to your question, I think it's actually the most rational thing to do for people like me to take risk,
Yeah.
and particularly in an area that has a lot of uncertainty, because if it fails, there's actually somewhere to go to,
Exactly.
albeit not as pleasant as the entrepreneurial journey.
Exactly, and actually, I think way more people should just heed that advice, because you need that kind of expertise doing the big businesses, the hairy, ugly situations and complexities. You need that kind of expertise and background to
Right.
more people like that. Now, getting into the credit gap, we've got a banking heritage. And at the time, you mentioned that the way Diamond Bank was doing retail banking, you just spotted the gaps, right? For me, one of the big questions is that over the last 10 years, this idea of consumer finance has kind of been proven out by your company and a whole number of other companies. And, the big question is that why did this gap exist at that point? Why specifically? What are the structural reasons that were making banks not take advantage of this massive credit gap? Because you mentioned largest economy, largest population. For sure, consumer finance is a big thing, should be a big thing.
Yes, so I think there are three main reasons. The first is that banks are just making too much money. If you're a Nigerian bank in 2010, for example, you'd collect customer deposits at 2-3%, and you could invest those in government bonds that were yielding, high teens, 20%. Wow. So you could literally just take customers' deposits, put it into treasury bills, go away for a year, collect 18+% risk-free money.
Yeah.
Why bother lending, right? It didn't make sense. Second reason was just the lack of a credit infrastructure. So I think the credit bureaus weren't really up and running then. And even if they were, they didn't have the data to actually provide scores because banks were not lending.
Yeah.
And then, the last thing was also that a few banks had tried, giving credit cards, but the reasons we mentioned, you didn't have the credit analytics skills, you didn't have credit bureau data to guide you, and they made some really stupid errors by just opening the tabs, giving money out.
Yeah.
So you had a couple of banks that launched credit card schemes, massive failures, and so within the banking sector, suggesting let's do credit was just not a good idea, right? There's just no good experience of credit.
Yeah.
And that's the market we entered. One where at that time, for the large population you talked about, maybe we're 150, 160 million people, let's say 50% adults, right? So 80 million. There were 200,000 credit cards. That's like the entry product for any banking sector into credit card. Yeah. Only 200,000. Today it's probably about 400,000, maybe. We're talking 15 years after.
Yeah.
And it's just indicative of the reluctance or unwillingness for banks to go into a market that all the world over is making banks billions of dollars.
Exactly.
So I think that was the context that we saw and the opportunity.
And like especially in Nigeria, some of the corporates are so massive. You talk about Dangote, the oil and gas industry. So between that and the government bonds, you have enough demand for credit to just completely ignore retail credit and still survive, actually thrive.
Without doubt, thrive. And look, it's changed today because they've seen how the likes of ourselves and others have made a market, and they've reacted. But at the time, how we got into this is actually quite funny, because in a different world before that, my brother and I we actually had a distressed investing fund.
Yep.
And the idea was to actually go to the banks, buy their non-performing debt for manufacturers, retail companies, invest in them, turn them around, sell. And we couldn't get that right. But the banks kept offering us, hey, what about our retail debt? Again, that debt I talked to you that they had done poorly.
Yeah.
And after about 7 banks said the same thing, we said, hey, maybe let's look at this retail debt, credit cards, a few personal loans, and see if we can collect on it. If we collect on it, let's go and buy it.
Yeah.
So we actually set up a debt collection firm. This is the genesis of Carbon. We set up a debt collection firm. We actually worked with 5 Nigerian banks. We said, okay, we'll collect and see if it works out, then maybe we can buy the portfolio off you. We learned 3 amazing things. One, we realized how bad the banks were at giving credit. So you find that most times the customer was in in debt or had a bad debt because the bank has actually given that individual too much money. Maybe I can only afford 100,000 naira. You gave me 3 million.
Yeah.
Right. So I was definitely going to default. It's an accident waiting to happen.
Yeah.
Two, there was high willingness to pay. Unlike the perception at the time that Nigerians will never pay back, the people we spoke to were grateful for the opportunity the banks had given them in terms of the cash. They wanted to pay back, but Nigeria had caused the problem, whether it was accident, health emergency with no insurance, or just a change in the valuation. My goods were stuck at the port, etc. But there was high willingness to pay. And then the third thing, which got us excited, was that nobody was doing this. Nobody was doing this, right? Huge opportunity. We looked at the rest of the world, everywhere, retail lending, whether it was in Russia, the likes of Tinkoff, South Africa, Capitec. And we knew that the model was going to come to Nigeria. It was a question of when, not if.
Yeah.
And it was like, if not us, then who? And so we set up, what was, one credit then to take advantage of the opportunity.
I know it's interesting you say that. I've spoken to so many people who've built, whether it's digital or just lending operations, and the core insight is always that a huge chunk of the people actually want to pay their loans, unlike the perception, and so it's interesting you say that. But now you mentioned one credit, and that was going to be my next question. One credit, you set up one credit, and my understanding is that you were giving salary-based loans, right?
Correct.
So what was the core insight into paper-based, salary-based loans?
Yeah, so at the time, so we're talking 2012 here. 2012, there was actually a strong payroll business or civil service payroll business where the banks were happy to give civil servants money. So they would lend a civil servant, and at the end of the month, they would go to the head of the whatever civil services was, water corporation, state government, and they would just get a check. But they knew they would get their money back. But the private sector didn't have any loans. And so the idea was, let's beat the existing customer experience, which was I go to a bank to apply for a loan. I fill out, all manner of forms. They take 2 weeks to say no to me, unless I have a house to give them.
Yeah.
Right. So the only lending that was taking place, if at all, was with collateral.
Yeah.
And so the one credit proposition was, let us improve the service. Let's make it a 24-hour service. So, and 24-hour service, and we would get you your answer. And if we said yes, it's going to be unsecured. So no collateral. And how we do this, we'll do the basic, credit risk checks, looking at data that everywhere around the world will look at, capacity to pay. And the one change we made was that, in lending, you're assessing capacity to pay. Does this person have the money to pay back? But importantly, willingness. Will they pay back?
Yeah.
The only way to answer the willingness question is to lend money. And so with one credit, what we said was that we'd give a small amount first.
Yeah.
And if the person paid back, then we'd give her a second loan. And then a third loan. And with each time would improve the offer, either a larger amount, longer tenor, lower interest rate, or all three. And that's how we started. We invested in technology on the back end, not on the front end. So it was still paper based. It was still, I lent you money for 12 months. I'll say, please give me 12 checks pre-signed.
Exactly.
And so that was a model that worked initially, but as you can imagine, it's not something that we wanted to stay with, because you were trying to reduce your credit risk by taking these checks. At the time in Nigeria, a check that bounced was actually an offense.
Yeah, it's a criminal. It wasn't really. It was a criminal case.
Yeah, right? It wasn't really enforced, but it was an offense. So it was that social pressure.
Yeah.
But you went from that credit risk to an operational risk, where now I have this office with signed checks from customers. That's an operational risk I don't want to. I don't want to get involved with.
But it seems the core idea then was just to really validate the market. And what I'm getting from you also is that the big idea was that you actually have to start now building your own data. And that's why it's important to start
Correct.
by, issuing these loans and building your own data so that you can slowly be say that, Samora is good for 1 million. And I'm the only one in Nigeria that knows that Samora is good for 1 million.
Correct. Absolutely. And it's funny because initially in the early days, we would give loans. We'll try and say, okay, let's check Samora's credit history. And we'll now see the data from the credit bureau, and it was the data we had given to the credit bureau. Now things are much better now because there are many more people, etc.
Yeah.
But that was the industry that we started in, where it was ground zero for us, the lenders, and also the credit bureaus as well.
Yeah. And then now you move from this paper-based system. You mentioned the biggest issue there was the operational risk into like an agent network, like an agent sales kind of network. Can you just describe what that is? How it worked, and specifically why that was the next iteration of the business.
Yeah, it was actually the first step. So for us, it's all about distribution, right? And again, we hadn't gotten to the point where there was a proliferation of mass proliferation of phones or smartphones. So we had up to 100 sales agents, and they were people who we hired to literally just stay outside, go to fast food restaurants, go on public transport buses, and basically marketing, hey, if you want a loan, One Credit can give you a loan. And so it was a very customized, personalized service where these agents would go out for the day, meet people, maybe help them fill the application forms, etc., and then come back to the office, right, with the documents, checks, etc., and then the loans will be disbursed, and the money will be sent to, if you like, the legacy bank accounts that these customers had. At that point, we didn't have any current accounts, so the money we were given was being sent to this individual. And, at the time, the initial amount was 10,000 naira, which was, was 50 naira. I'll never forget, because initially we went to banks to say, can you give us warehouse financing to lend? And, every bank laughed at us. It was like, who needs 10,000 naira, right? You're going to give this money unsecured? Nigerians don't pay back, almost like as your senior brother, don't do this, you're going to waste your money.
You should know better.
What was funny, though, is that we should know better. What was funny, though, we'd leave the meeting and some of those bankers would be applying for loans as well, right? But there was this negative perception that being a borrower was a bad thing, which is a perception that we've tried to fight. If you borrowed money, you were irresponsible, right? Particularly if you were borrowing from these
kind of guys,
these digital banks that don't wear suits, wear hoodies.
You look like Shylocks. These are Shylocks. You don't know who you're messing with. But that's a very interesting story.
Exactly.
And so from there now, you kind of went into Paylater, right? Which was now a more digital proposition. And it seems to me the logic was that this business is growing. There's so much operational risk from agents not only handling like checks and doing both sales and operational roles, and therefore it just makes a lot of sense to kind of digitize the entire thing. Is that the logic that led you to Paylater?
Yeah, the logic is there, but also the things had changed in the industry. So we launched Paylater 2016. 2015, Paystack launches, right? So now you can take online payments. By that point, you also have, increasingly high smartphone penetration. I think at that point it was over 30%. You've had the introduction of the bank verification number. Right, which is like a unique ID for the Nigerian financial system. So now you're solving a few problems. Identity. This BVN, this is the individual. You're solving payments. I don't have to take 10, 12 checks. I can just get paid electronically. And then also just the speed and the social construct. nobody wants to be seen speaking to an agent, or an agent coming to the office to help you get a loan, because that means you have an issue. But just the fact that, you're speaking to me right now, you're applying for a loan.
Yeah.
Paylater was a 5-minute product.
Yeah.
Fill out the form. What's your name? Employee, employment, how much you earn, etc. And we use the same principle as before. Is we're just going to be a small loan initially, and if you pay back, then we can give you more.
Yeah.
So that was the thing. It was a confluence of events, and also the fact that Duke and I didn't like the one credit model. It was a working model. I mean, we had people internally who were pushing against it. They told us this mobile thing will never work. In fact, it's going to fail. Right. So there was even internal resistance, because you've got to understand, even your staff, your colleagues, you're going through uncharted territory, right? I remember the first time we hit 1,000 loans a day. One of my engineers came to me and said, "Ngozi, I'll be honest with you, I actually never believed that this thing would work." Right? I did, I can build it, but I didn't believe that we could give loans at that scale profitably.
Yeah.
Because they too come from the same society, and they're like, Nigerians don't pay. So it was exciting times, and we're just changing the narrative, because now you weren't even taking a day, literally within the time it took you to download the app. It was Android at the time. You'd send your data, we'd run our machine learning models on it, would give you a small loan. And then if you paid back, then actually getting new loans were just even so much faster. I mean, it was revolutionary in the market.
That's interesting. I mean, I think now is when I understand, I'm getting a better understanding of why, this kind of models and credit scoring models are so important for you, because that was your core advantage. But then now digging into that, I think I've listened to a few podcasts where your brother is talking about, your whole approach to credit scoring, that you still maintain your proprietary models, despite the fact that the industry has kind of come up with its own kind of credit scoring. It's not 12 years ago where there was complete lack of credit scoring. And I think the big question is that there are such dislocations in Nigeria's economy, right? Like, things just are not linear, right? Like, you have when you guys were starting this business, the dollar was like 150 naira. Now it's 10 times that, right? So statistically,
it's like you want to make me cry. You want to make me cry on this podcast.
No, but statistically, like, models in an environment of such dislocations, like, they have their limitations. So why do you insist on maintaining this kind of proprietary models up to today?
I think the simple answer is that they work. So we've had, what's now 13 years of lending experience. We've gone through at least 4 economic crises, whether it's COVID, whether it's different spikes in devaluation. And we've tried to maintain, around a 10 to 13% loss ratio throughout. We think that's the optimum between, profitability, and responsible lending, and the recouping things like inflation. And so the model just work. The models work. So that's the simple answer. I think for us, the reason we're in this business is that we think credit is a superpower. We think that it is a fuel for economic growth, for personal growth, etc. And so we push against the view that it's irresponsible to borrow money. We think it's, when you want to pay school fees but you don't have the money, when you have a healthcare emergency, when you want to invest in your business. Credit has fueled economies all around the world. And so our approach has been, how can we lend responsibly and also reward customers? So one of the things we started off very early was giving away free credit reports. So literally you came onto our platform. We're now post Paylater now. This is now when we actually have we've gone into We're going into carbon. Actually, no, it's actually Paylater. It's actually Paylater. And we're trying to push the concept of responsible lending, responsible borrowing. And so whether we reject you or we give you a loan, like before you could even apply for the loan, you had the chance to actually just check your credit report. And we were checking it and we're like, you should check it as well. Every time you pay back a loan, the next loan is going to be a better loan. Ideally, cheaper interest rate, longer tenor, so it's more affordable, or a larger amount of money if you can pay back. And so that's our goal. And I think it's very easy to give away money. Any fool can do it. Sit in the corner of the street, you have customers. And so because in service of that mission, responsible credit that is productive, the models are very useful because they make sure that we don't give out too much money. We're looking at, okay, how much can Samora really afford, right? We're looking at if maybe we gave you, 100 shillings, right? Or we offered you 100 shillings. You took only 60. That's a positive in our book because that shows that you're actually responsible. You're not taking out everything that that is available. And so then that will then, will now give you a bonus tick mark there, And so for us, the models are geared towards that kind of long-term sustainable lending to protect us and, more importantly, the customer.
And what I'm getting from you is that, in the credit lending business, the first thing is get to your yes or no, right? And that's the first thing that your kind of model has to do. But what I'm getting from you also is that there's this higher value of like once you've gotten to a yes or no, let's refine amount, tenor, all this kind of stuff, and that's
Correct.
like what now adds really long-term value in the long term, because now your decisions are first yes and no, and also now the right amount to maintain this kind of 10% thing. Because as you said, people have come into the market, a very short space later they close, and the biggest thing is you're not fine-tuning that model to ensure that your pricing, first of all, is appropriate, but also your loss is like standard. It's not going up and down, because for your model, if you go to 30%, you're wiped out. If you go to 40%, you're wiped out.
Yeah. Correct. Exactly. And it's lending is it's all these businesses that everyone thinks they can get into because they think, one, there's always high demand in our markets. There's always high demand. Two, people are desperate, and so I can charge a very high interest rate. We've worked really hard on bringing down interest rates because if you think about it, if I charge a high interest rate, right, the people that I'm attracting are the desperate, and many of them are like, charge me 100%. I'm not going to pay. I have no intention of paying. So the lower your interest rate, the bigger your addressable market becomes. And so that's the importance of actually, again, the models, is that it allows you to charge a low interest rate. Our goal has always been, can we get this right such that we, with our data, we're able to provide loans at the same rate as the banks, even when albeit without collateral. Because when we do that, we win.
Exactly.
We win. So that's exciting. We're not there yet, but we're working on it.
And in your 12 years experience, there's the building your models. So there's a decision to build your models, but there's an org structure that goes behind it. There's a culture that goes in. There's a technology that goes in. Would you be able to walk us through, like, what do you think you need to get right, and mostly from an organizational perspective, to build a very robust credit department and credit scoring mechanism within an alternative lender?
So I think I'll take a step back and speak broadly. What do you think need to get right in terms of the people? And I think we actually did this wrong. I think, we all read the books, culture. When you're growing fast and it's exciting, you forget about culture. We certainly did. And so the first thing I would say is everyone should be mission driven, right? And people coming in really understand the mission of, we're trying to empower customers, we're trying to change the credit culture in Nigeria, we're trying to make this thing a superpower, not a negative thing. I want you to proudly say, I borrowed money to finance my education, to invest in my business, to send my daughter to school. That's, so I think that's the first step, right? Because once you have that, it alters the way you treat customers, right? We've seen how people treat debtors, right, in other debt collection firms. It's abuse, But if you understand that these customers were taking this money to try and better themselves, then most of the time when they don't pay, it's not that they didn't want to pay, right? It's because they fell on hard times, right? Or Nigeria happened to them. Or, and this is important, we made a mistake by giving them too much money, by actually giving them money. And so we have we have some blame in that regard. So in terms of the credit, the credit team, now given our model, it's highly data analytic, right? Because you're not, I want to give you money, Samora, I meet you somewhere. I'm already assessing you, doing a lot of things. Can he pay? Is he of good disposition? Do I trust him? So there's a lot of credit analysis that agents are doing when they meet in person. And then now we have to say, how do we do that internally, right? So there's what questions will I ask? There's also initially, for example, we would measure, and this is where the engineering team is important, would have features where we'll see, for example, how many times did you change your salary when you were filling it out, right? You would have analysts to see how... exactly. You would need analysts to actually analyze the data. So there's one thing, there's a credit team to who have experience in understanding debt to income ratios, to responsible lending. There's an analysis team as part of that broader risk team to analyze the data and say, okay, does this make sense? When we started, we were allowed to collect a lot of information. So when you downloaded the app, for example, would ask you for permission to download your SMS messages, your location, your contact data, etc. So it's with the customer's permission. Now, we weren't reading it like your SMSs, but what we're looking for was the financial alert you'd get from your banks, etc., or from your telco when you bought credit. So you say, for example, I earn 100,000 naira. And then we're looking for, okay, do we see alerts that are synonymous with that level of amount, right? We'll then look at, say like your SMS alert from your telco, MTN, Globalcom, whoever, and say, okay, what kind of data are you buying, right? Are you buying 5 gigabytes of data, 5,000 naira, one purchase? Are you buying every 4 days? These are indicators of either your income levels or your financial disposition. Are you somebody who likes to save and plan and get that bulk discount? Or are you like, okay, no, I just want to pay small. So that was a key part of the criteria in giving a loan, and even in giving a loan, how much would give to this person, and over what tenor. So so you need people who are analytical, who like puzzles, and who like the new, because quite frankly, at the time, if you think about it, we couldn't recruit from the legacy banks, because what was their experience as a credit risk analyst is, Shade, you want to loan? No problem, we'll give you a loan. Just go and bring your mother's house. That's the lending criteria. Versus unsecured, you need to analyze the data. Can we trust this person? What in the data has given us comfort? And not just like, to your point, it's not just yes or no. It's how much, at what price, over what period. And so it's I think you need people that are analytical, curious, comfortable with data as well. They like problem solving.
It's interesting you say that, because I think, if you look through, global fintechs, one of the key things that comes out is, this thing of recruiting outsiders and bringing people who look at things differently. The talent is still there. You still need to get A-type players, but just bring people who are curious. Now, what is like one of the most, because you've built these models, you've been looking at these things for over 12 years. What is one of the most counterintuitive things you've come across in terms of like being able to detect a good borrower? For sure, the best predictor of good repayment is past repayment. But what other counterintuitive thing have you come across? Like, wow, I didn't know that this thing actually matters when it comes to checking good repayment.
Let me think about that. The one thing that has always struck me, is one, the higher the income, broadly speaking, the worse the borrower. Right? Higher the income, the worse the borrower. Particularly amongst men.
Yeah.
The other thing that was interesting that we did a study a while back. It's some time ago, but probably still holds today, and it was looking at the rate of default across men and women. And at the time, let me see if I get this right. At the time, there were no changes in default, right? So for income, etc., there was no significant variation in the credit results of men and women. So you have this like women are better borrowers, they pay back in time, etc. But we didn't see that in our data. My hypothesis now, we historically have had 70% of our customers or borrowers being men, 30% being women. So there's almost like 20% that we're missing, of the women.
Yeah.
And my hypothesis has been that there's a type of person that comes to borrow, right? And look, our rates are higher than the banks, etc. It's a quick loan.
Yeah.
When you come to borrow, you're almost like you're the same person. You're the same personality, right? Whether you're male or female, right? But then there's a group of women that are more risk averse and they don't come. So if you blend all the women together, then there's definitely lower default, right? Because they're not even engaging in the credit system.
Exactly.
But when you actually come and we didn't see significant difference between male and female borrowers, contrary to the perception that females are better borrowers.
And I think the income thing is probably like a lifestyle group that just comes up. The more income you get, the more you spend money on things. Whereas like if you're at the bottom, not the lower level, you kind of know that these are my parameters. I'm going to live in this area. I'm not going to drive a car and all that kind of stuff.
Right.
Right.
So there's that, and I think there are two other issues as well. I think one's a power thing, right? I brought a large amount of money. Like there's a sense that who are you to come and chase me, right? I'm a big man, etc. But I think the more important point though is that those of lower income who don't have all the advantages realize that this is actually very useful. And if I can just keep paying my credit, I will get more and I can do more and hopefully get to some of the advantages that these other, the elites or those in high income have. I think that's the critical point.
Got it.
That we see.
Yeah, I mean, it's like this is everything and I can't screw this up. Like if I screw this up, then
exactly,
I'm pulling the...
It's got nothing.
Yeah. Now, very interesting discussion and, very useful insight. So we were at the Paylater stage. Now it's carbon, right?
Yeah.
And now, I think part of what you're saying is that, the surrounding infrastructure around that time, the pay stacks, the Flutterwaves, the BVNs, the NIBs got very advanced.
Yeah.
You then now decided to go into a full kind of service, financial services firm.
Yeah.
Just walk us quickly through that.
Yeah. So the goal from day one was always to be a full-fledged bank.
Okay.
But the first problem was going to be lending, because that was the opportunity. That's what was missing in the banking sector. So that was always the goal, to go into that. And so the brand one was to be like a one service shop for all your financial needs. That was the rationale behind it. But we started with one credit. So why become a full-fledged bank? If you're a lender, your fuel is capital.
Yeah.
And the money we were using to lend was being borrowed from high high yield investors,
Yeah.
asset managers
Yeah.
at a high interest rate.
Yeah.
So typically, at the time, we're probably paying high teens to 20% annual for the money we're then lending. So our rates would have to be higher. Contrast that with the banks, where their cost of funds, so a typical customer will put their money in their bank account, they would get maybe 1%.
Yeah.
So the banks had a huge advantage over us. And so for us, our thinking was that for us to be able to compete with the banks, we need cheap capital like them. And so we then went, so that was one of the rationale for going to full service banking at the time. I think it was a mistake. We were going to get there, but the truth is, and this is something that we've learned in retrospect, when you go from a lender to a full-fledged bank, you're a different beast. And we did not appreciate that at the time. When we were Paylater, every customer that came, we knew exactly what they were coming for. We had optimized the customer journey. We knew we were coming for a loan, and it was clear. We had a very, very unique and simple relationship. You now say, I'm a bank and I can give you so many things. Now, when that customer is coming, are they coming for a loan? Are they coming for a debit card? Are they coming for savings? Are they coming for payments? You've literally just taken your complexity to an exponential level. We didn't appreciate that. We didn't, for us, it was just like, oh, we'll just get cheap capital. Then also, and this is a lesson for other entrepreneurs, we hadn't earned the right to give those services at the time, right? If Ngozi and Jogi could go back in time, we'll get to a point where we've gotten this lending so good, right? That we've cut the default, we've cut the interest rates. And then now that customers really loved us, they will now say, hey, okay, let's now add another product, after doing some customer research. So I think we're a bit too excited in retrospect. I did appreciate the complexity of different customers, different journeys, different messaging in the market. At the time, Paylater was borrow 10K, get 20, borrow 20, get 40, borrow 40, get 80. It was a beautiful, clear message, So the intent was the right one. The one thing that we've learned over time as well is that, you talk about how there's a lot of resistance between shifting banks, a lot of trust built in your banking relationship. Our experience is that people hate their banks. Speaking from a Nigerian perspective, they hate their banks, they hate their service. If you go on Twitter, you see it all, but they trust their bank. This is the bank of my grandfather, my grandmother, me. I see all the things that we used to rail against. To investors, we're capital light, we're data centric. Those massive buildings instill trust in the customers. Those adverts that all look the same instill trust in the customer. So we've had customers, we're doing research and we're like, okay, what's your experience with the Carbon? Carbon's been amazing to me. When my son was ill, Carbon financed the medical. When I went to open my new shop, Carbon did that, did this. Okay, so would you put money in Carbon in your savings account? I suppose I could. I guess, yeah, maybe I could. So it shows you that there's a huge gap. There's a huge gap. And I think we didn't appreciate that. We think, okay, all these customers, now you have a Carbon savings account, you expect the coffers to be full. And that wasn't our experience initially. Much better now, but that's because we spent time building trust, building the brand. Money is a serious business.
Now, the Carbon story is ongoing. There's all this stuff going on, but you're producing your financial results and you're doing pretty well. You're making very good revenue, and I used to find it so fascinating. I think you are the only fintech, maybe not just in Africa, but just like globally, who's producing audited results. The business is growing. Right. You can see the trajectory, and then COVID happened, right?
Yes.
And I think you later released a report in 2022 that kind of covered the COVID period. And,
Correct.
I could just see blood in your books. It was a messy affair. It was. I was just like, oh man, these guys are going through it. So can you just walk us through that period as carbon and the COVID effect in your business?
Yeah, so I mean, 2019. I think pre-2019, we were probably in the last 5 years. I mean, we were profitable. We were growing 50% year on year. And entering to 2020, we had, I mean, the plans we had for world domination were amazing. And then, of course, COVID hit.
Yeah.
So, I remember we were part of a group of endeavor entrepreneurs who were just talking to each other, all lenders. What are you seeing, in Mexico? And I was like, oh no, our books are fine. I think everything is going to be good. And the individual said, check your 1 day MPL. So your MPL, not over the last 30 days, but over the last day. And we saw a spike, right? And this was a sign that trouble was coming. And so in retrospect, we panicked. And so we changed our models overnight. So if we gave you 1,000 naira, as your debt limit, we cut that by 80%, right? Across the board, right? Because everyone was telling us, who knows how long this is going to last? Who knows what's going to happen? You've got to preserve capital. The business has to survive. So it was quite existential. So what happens then? People who are due to pay their loans, right, see that other people's loans are getting cut. And in our business, it's almost like a revolving credit line. You pay back, most people will take money within the next 2 months. And so the perspective was, if I pay back now, I'm not sure I'm going to get the same amount back. So I'm not going to pay. So we saw default spike. And not out of bad intent, just out of survival. They were doing what we were doing, which is preserving our capital and just making sure. Exactly. In retrospect, if I could go back in time, I would still cut the lines that we're given, but focus on our best customers, because the perspective from our customer, and we got this from research and talking to them, was that in my time of need, you abandoned me. So there's always a fear that customers won't pay, but there are customers who pay back all the time, religiously, pay back early, and those customers like, I've never failed you. But when I needed you most, you just shut me down and you treat me like everybody else, So that was a huge lesson in the relationship, and I want that, look, if I'm kind to ourselves, it was a global pandemic. It's the first time we've seen it. But it shows you how, you can lose that relationship over a decision that is not thought through. And if I'm honest with ourselves, we were not thinking from the customer's perspective. Right?
I mean, it's a really high stress situation. Like, it's a relatively young business. You look at this one whatever NPLs, 1 day NPLs, it's existential. And, so there's a lot going on. And, of course, with the benefit of doubt, with the, benefit of hindsight, you can look at it and say, this is what we should have done. But you're in the fog of war, and, those are the decisions you made.
Correct. Yeah. And again, this is the benefit of, duration, right? This is why the JP Morgans, they have all that institutional memory, going through civil wars, etc. Now we would have the benefit of that experience and make a different decision. Right? But coming out of that, so the growth clearly slowed. We went into loss making. We're not yet profitable again. So this is 5 years on, just to tell you how impactful that was from 50% year-on-year growth, annualized and profitable, to where we're like, wow, slowed down, equity was depleted. And of course, other competitors, who didn't have that issue of COVID, coming in after, now eating market share. And then of course the market has grown significantly. The banks have piled in as well. They've all put their own quick loan services in. So it's a now different world. And I think it's an exciting world now because now, in many ways, we're happy because what we tried to do, we're not there yet, but it has been successful. The goal was to give people access to credit when they need it. There's still a lot of work to be done, but that goal has been achieved,
Yeah.
right? And I think it's actually a different world. If you take a step back, I think we're at a point now where if you're somebody that's relatively young and you're going to take a loan, you're probably going to take it from a fintech rather than a bank.
Yeah.
That's a shift that people don't appreciate, right?
Yeah.
And our goal now is to now extend that penetration to things like savings account, and people like PiggyVest have done a phenomenal job and things like that. But how do we now get to the point where the likes of Carbon or competitors are the first port of call for that new graduate when she's looking for her a bank of choice, etc.
Yeah, and I think you raise an interesting point. I read recently that Gen Zs have got the highest proportion of subscription services, like almost 3 times the level of Gen X's, and it just shows this whole thing in understanding digital value and being able to pay for digital value. And I think it also extends into digital trust, right? So I think that works well for fintechs. And now, one of the things now, I think I read that you're now doing SME lending, and in fact, it's a significant chunk of your book, right? How did that happen, or was it just that you found that a lot of the people who are actually borrowing for business reasons, and therefore let's now go into SMEs? How did that happen?
Yes. So when we did research on our customers, our retail customers, we found that 50% identified as SMEs, right? Now, when you dig deep, most of them who identified as SMEs were people who were in a formal job 9 to 5, but had a gig on the side, whether they were selling shirts, had a small store, or were an Instagram influencer, and they were trying to build that business. And so, again, taking a step back, if we look strategically, from our perspective, that retail game is now very competitive. But what is still underserved is SMEs. Individuals, for the most part, look the same. You and I look different, but as an individual, in aggregate, we're very similar. SMEs are completely different, different supply chains, different products, different organization structures. And so we decided to really make a big push on SMEs. We were doing SME lending for some time, just pure play SME lending. But we actually said, let's go into the full-fledged SME banking. So we did an acquisition of a small SME tech provider, Vela, at the start of last year. And now we've got what we believe is the best SME bank, where you can do banking, invoice discounting. Very soon we'll be launching things like payroll, etc. So I think in the future, you'll probably think of us more of an SME bank, in terms of at least the loans that were being dispersed, because we think that's the opportunity right now. If you look at the Nigerian stats, the consumer has really suffered. Some of the stats you mentioned, whether it's devaluation, whether it's power going 5 times, inflation at 30%, which I think is underestimated. So the capacity to pay is quite low. A few years ago, so just after COVID, I think our approval rate for new customers was around 40%. We took it down to about 5% because we saw that there was a huge proliferation of bad debt. Your typical customer maybe would have another loan, would now have 3 loans outstanding, maybe one not paid. So the risk in the system has just been has worsened. Whereas we think that SMEs, which are the bedrock of any economy, are being starved of cash. And despite as the exchange rate worsens, it means imports are more expensive, but it also means that homegrown goods and services have an opportunity. But that can't happen unless these SMEs have the fuel in
Exactly.
credit. That's the real focus of ours right now.
And it actually leads me to the next question, because you've mentioned that the competitive environment has really changed. First of all, there's things
Yeah.
like embedded lending, which people like Omni Retail are doing. There's
Yeah.
entrants like MoneyPoint who've really now focused on SMEs. Like what specific wedge are you looking at in terms of like this is the competitive positioning that we can take given everything that's happening, and this
Right.
is where we can we think we can win.
Yeah. So I think the approach you and I have always taken is that we don't want to be the biggest. We don't want to have the largest revenue. We don't want to be the most profitable necessarily. We want to do exciting things. We want to build things that need to exist. And that's what drives us. Now, in terms of where we are positioning ourselves, is we're now looking at SMEs beyond finance. Everyone can learn finance, but our approach, and we've done this with customers as well, is let me try and solve the problems that you actually have rather than your finance problem. So, a classic case is like, okay, you need a loan for your daughter's medical treatment. I can lend you the money, but I can maybe try and find ways to actually help you get health insurance way before you need that loan. In the case of SMEs, we're really focused on. So I think there's two things. One, we are really focused on the entrepreneur, the head of that SME. Everyone looks at the company. We're looking at how can we help the individual or the team actually be more productive. And that means, yes, we'll lend you money, but how can we help you with content generation? How can we help you with your operations? Many of the SMEs we talk about, they're looking at, I like to borrow and grow, but I'm not even comfortable with my operations yet. We are, over the last 6 months, have done a lot of work in automation and using AI. Everyone uses AI, I know. But our approach is we have done amazing things on our back end in terms of how we recruit, how we reconcile payments, how we're generating content using automation and AI. And our goal is to pass it on to the SMEs, either as part of a bundled service or as a fee. But ultimately, the approach is we're not looking to help your financial needs. We're looking to help you and your business with the things that are keeping you up at night. Nigeria is hard, right? The problem is not, can I pay my medical loan? The problem is, how am I going to manage my medical loan, my salaries, my creditors, my children's school fees? That's a burden that entrepreneurs, teams are suffering with. Nobody's looking at that. People are just looking at, I can give you financing, I can give you POS financing. But we're looking at taking a step back and say, okay, how do we get you to a point where you can manage your operations? And so if you look at our SME app right now, there's a cash flow analysis that's AI powered that you can use in our SME app right now. We are offering a few clients right now a beta version of a reconciler, a payments reconciliation service. And for context, we reconcile thousands of payments daily between the payments providers, Paystack, Nibs, and our core banking application. This is work that used to take like an analyst 3 hours a day via Excel. It's now 10 seconds, right? Those are the things we can pass on to people such that they can look for fraud in their accounts, reconcile the accounts, etc. So that's the differentiation for us. Is not so much. It's like, what are the really hard problems that we can solve? We know how to lend to SMEs. We're doing that. I do that with my eyes closed. It's how can I actually even help them so that maybe because they're more productive, maybe because they can now use a Mid-Journey or OpenAI content generation, they don't need to hire that graphic designer, or that graphic designer can do something that's more productive. That's what excites us, and that's very exciting right now.
And it's interesting you say that because 20 or 30 years ago, whenever this was, the founders of Access Bank actually rolled up their sleeves, went into these corporates, and actually consulted they did kind
Yeah.
of like value chain consulting, and just speaks to the idea
Yeah.
of like adding value beyond just the core financial services as a differentiator. And everyone is talking about, for instance, lifestyle banking, the retail perspective. Very few people are actually doing lifestyle banking, but I think the core of the message is that you have to be more than just a financial services provider. You have to now really get into the lives of your customers. And then, maybe the question is that
Correct.
how does this look like, 5 years from now, in terms of like the value proposition, where carbon is it going to be carbon bank? Because is
Yeah.
that what you're looking at?
Yeah. So I would say two contradictory things. I would say that we're building the bank of the future right now. And I will then also tell you that people are not looking for a bank; they're looking for a solution to their problems, right? But in the conventional sense, we're looking for the bank of the future. And what does that mean? That means, for example, you as an individual want customized service, whether as an individual or as an SME.
Yeah.
You've got opportunities, challenges, expenses. You want a trusted partner to advise you on that. Now, the issue is that ideally you would have a branch manager or wealth manager that would now sit down with you, Samora, and walk you through all these things. Oh, here's what you should do. Here's how you should invest, etc. Can't do that right now. But there's definitely a world where you can customize AI agents that know your data, your transactions on carbon, your goals, aspirations, and give you advice. It might not be the advice you take them to the market, but it answers some of the basic questions that you have, right? So I think there's that. I think I see a world where there's huge automation, right? Where a lot of what we're doing right now, whether it's chargebacks, whether it's fraud reconciliation, is automated, right? It's automated and it's 24/7. The dirty secret about fintech is that it's actually highly operational intensive.
Yeah, for
right?
sure.
Because of the pipes that are broken on the back
Exactly.
end. Right?
Yeah.
We see a world where those don't exist. From a banking perspective, what does that mean? It means much lower cost to income, right? Your operational cost is low. Your scale is broader. We have a 24-hour service, right? But what does that mean? That means somebody needs to be at the customer's beck and call, all the time. Or people need to sleep. But you get to a point where you can actually solve these problems.
Yeah.
But ultimately, we want a world where we're helping customers solve their problems. Well, almost like the way I see carbon is your superpower. It's that your secret weapon in your pocket. And it's almost like before you want a loan, we've helped you solve those problems.
Yeah.
So instead of borrowing a loan to send your DHL shipment, can we get you a payment plan that we can facilitate? We've got this buy now, pay later product. So you don't need to borrow money, right? It's exercise.
Yeah.
Can we help you finance or get a payment plan for family health insurance? So that those healthcare medicines don't exist. For us, that's the future. It's, to your point, it's not just, it's going deep and asking why. Why do you want this loan, right? Why was health insurance not or fire and theft insurance not an option?
Yeah.
Right? Okay, let's solve that problem. That's, for us, that's, I think, what we are doing right now that I don't see anybody else doing. I see a lot of, okay, let's grow the book, even embedded finance, let's just finance, but I don't see a lot of how do we solve the problem.
Yeah.
I'm spending 3-4 hours a day on AI and automation. It's a hackneyed phrase. A lot of the work that needs to be done is more automation than AI.
Yeah.
But, as many people say, the artificial intelligence that we're using right now is the worst that we'll ever use.
Yeah.
When you think about that, it's even a scary thought, because tomorrow I'll tell you there's a world in which there's some AI-powered banks that are being built that are going to take me out of business very soon, right?
Yeah.
So you need to be running faster,
Exactly.
right? Because we are also at risk.
And I think I share the same view as you, because this is just such a foundational technology. It's I think one of the biggest technologies we've ever come across, and it needs to be really, you have to rethink financial services from first principles. I know it sounds
Correct.
cliche talking about
Correct.
rethinking, but it's like when such a technology comes, just like how electricity changed the whole thing of like you can now do branches across the country as opposed to being regional or being within one city,
Correct.
because you can now interconnect all these branches.
Correct.
I think there's going to be that shift in terms of like how AI and financial services, and the main thing is going to be to help. Like, so now you can provide someone in Nigeria who earns like, I don't know, 500,000 naira, the same kind of wealth services that someone who's getting at UBS, because you've got such capabilities. Interestingly, there's this bank in China called WeBank, and they've got this kind of like advisory feature. And usually when it comes to wealth, most people are like, oh, we're going to stay away from giving you advice, blah, 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 blah. But they actually give you advice and tell you this is what you should do. And when they see you're getting too risky, they tell you, hey, this thing is getting too risky. You need to adjust, right? And it's like, that's how finance should work. Like, some of these rules sometimes may not make sense. And I'm glad to hear that's where you're going.
Yeah, no, definitely. When we survey SMEs, the top three things that they are looking for, it's not finance. It's tell me what I should do in terms of personal development. I don't understand this content generation, but but help me master so I can get customers. And then it's like maybe finance, right? Yeah. But it's like, how do I build a team? How do I find the right people? How do I do more with less? So again, going to that is why we ask entrepreneurs now, tell me what your problem is, right? And it's not capital. Sometimes it's capital, but most times it's not capital.
Yeah.
It's, you referenced this in the last email. People are leaving. How do I get talent? Right? How do I get talent? That's my real problem. How do I pay these salaries, to get, or the few that are left who are now in high demand? How do I pay that? Or how do I train the people that I have right now? Yeah. So for us, it's like, let's go to the fundamental problems, the things that are keeping you up at night. Yeah. Because if it's to borrow money, even as low as the system is, there are enough people who are looking to you to lend money to. It's these problems that are real, that are real, that are more exciting for me.
Currently, like what, just to wrap up, as you're managing this business, you're on this kind of recovery path. You're introducing this now whole idea of like solving fundamental problems as opposed to just selling loans, which is a very core insight. What are some of the core metrics that you're currently observing, that these are the things we need to get right this year? These are the things we need to get right now for this kind of future to be available.
Yeah. So I think for us, we're going back to the fundamentals, right? I think one is talent density. When we look around the people we see in the company, are they excellent? Are they all excellent? And it's hard to measure that, but this colleague of mine is committed. They have the license to execute and they have the capacity. I think that's the first metric. We have the right people on the bus, we win. Going more to financial or product metrics, then I think it's looking at the funnel and looking at the people that are coming in. How many of them actually converting into first customers? What percentage of that? Because that speaks to the efficiency of our marketing, our messaging, and also the quality of our systems. I might invite you into my house, but then you can't open the door, or the door is broken, right? Or you enter the house and like, I don't want to hang out with these people, right? So for us, it's like that core metric of conversion rate, of website to first transaction. Then on the other hand, it's the you were a customer last month. I used to be a customer with us. I used to, and by customer, I don't mean the e-commerce e-commerce version that's, your name is on my list, but you've done a financial transaction, right, in the last 30 days. Because that speaks to the value that you're getting from us compared to the other people. Those are the two core metrics. And the last is just engagement on the platform. If you're on the platform, and we have multiple services, lending, savings, payments, buy now, pay later. Is usage increasing? Because that speaks to value. There's no point us creating products, but nobody's using it. That's like solving or providing solutions when there are no problems.
Exactly.
So those are the three core metrics, and they're fundamental. And I don't think we've paid enough service to them historically. Now, I remember there was once around 2019, I met an American VC, and he was talking about our operations, etc. And he was like, you're it's really strange. You have like Series B like numbers, but your product knowledge or your org structure, right, is more like seed. I was a bit offended because I was like, who's this guy telling me?
Wait a minute.
He was absolutely right. Absolutely right. In retrospect, we weren't paying enough attention to the customer, the journey, walking on the feet of the customer, and then using data to make decisions. And again, those three things, the lending is almost it's almost second. The lending works, right? But it's those core things. Lending is just a subset of that customer value, right? Because you can get money from different places. It's a commodity. It's like I'm giving you money or services. How do you feel about Carbon, the brand? That's what we're really working on right now.
And it's just a maturing as an entrepreneur, and to get to this point, it's a journey you have to take. And are you happy with where those metrics are trending?
I am. What's the phrase? I'm happy but not content.
You can always do more.
Happy but not content. There's a long way to go. There's a long way to go. There's a long way to go. Particularly on the. I think in a world where, to your earlier comment, lots of digital banks, I think we've all been guilty of saying the same thing, having the same, brightly colored men and women on our posters, hip and funky. We haven't done a good job of really telling people why we're different, And again, it's that concept of Carbon. We want to be a superpower. We want to be a fair partner. We'll give you value, but we expect to be paid value. We don't believe in this free thing. But we want to make impact in your life beyond your financial needs, right? Why do you have these financial needs? That's what we're trying to do. And so I spend a lot of time, and Chijioke does as well, just thinking about how to execute that internally so that the team understands that. And so the customer also knows this is who we are and what we are. Because that's what ultimately will decide why you versus Fair Money versus Money Point, etc.
And I think that's, to be honest, that's what the previous generation of banks did well. They did very good comms and positioning. And everybody knew this is what GT Bank is all about. This is what Equity Bank is all about. And I think that's a job you guys have to do. And listen, man, this conversation has been amazing. Like, at least for me, it's gone way better than I expected. I think, tons of insights. Really, really good journey. I empathize with the entrepreneurial journey. I'm really rooting for you guys, and thanks for joining. Thanks for joining the podcast. So that's it, folks. It's been an amazing episode speaking to Ngozi Dozie. Very insightful, and thanks for watching the podcast. Thank you.